Hello, everybody. This is Andy Lebow of Commodity Research Group. Today, I'm joined by Marty Stetzer, the president of EKT Interactive, and my colleague and partner, top-rated metals analyst Ed Meir. And we're going to be talking about energy, metals, and trade, amongst other things, on our weekly report, our weekly podcast. Good morning, Marty.
Good morning, Andy. Nice to be with you again.
Likewise. And good morning, Ed.
Good morning, guys.
I think I'm going to start and talk a little bit about oil. The market today is getting hit pretty hard. Actually, the last 2 or 3 days has been under some severe pressure, falling today by $2.50. Today's May 23rd. We're down by $2.50 and down significantly from the highs of $66.60 made earlier in the month or last month. I think there are a couple of factors behind this unexpected decline. The first one, for many of you who have followed the commodity markets for years, or not even for years, is probably the fact that the market was lined up very much on the bull side. Almost everybody was bullish crude, including us, frankly. Looking at a tightening fundamental picture, we saw a huge buildup in the speculative interest on the commitment of traders. Net length just exploding over the last couple of weeks to get WTI at least to the point where it was something like 14-1 longs to short. And just a few weeks ago, it had been 3-1 longs to short. So big speculative interest, big bullish view by us and some of the banks throwing out numbers like $90. I saw one bank talk about $2.50. Problems in the Persian Gulf, which we'll talk about, and the market seemingly was set up for a move to new highs, and it just didn't happen, obviously. I think we've seen a big move. I know we've seen a big risk-off move in a lot of the markets owing to the failure of the Chinese-U.S. talks on trade, which has brought somewhat of a negative bias to a lot of the commodity markets. And I know Ed's going to talk about what's happened in copper and some of the metals, owing in part to the trade talk failure and concerns about demand. Now, what sparked our particular sell-off in crude was undoubtedly a fourth or fifth in a row bearish EIA report, which showed crude stocks for the week building by 5-6 million barrels. And crude stocks now, U.S. crude stocks, have built 40 million barrels over the last 9 weeks. We've gone from being a little tight on crude to now being more or less average. The day's supply, which is inventories divided by demand, are at 28.5. The 4-year average is 28.9, so we're at average levels, but not really tight by any means. And we're seeing that at least in the mid-continent, we're seeing a contango, or the first month is below the second month. And the market certainly did not expect that type of a build. And the reason we built so much, and we've talked about this in other podcasts, is that demand for crude through crude runs has been really soft. The runs are running like the crude runs are 16.5 million barrels a day right now for a week average. They should be closer to 17. The government thought that by now they'd be 17.4. So that's 1 million barrels a day of refinery capacity that hasn't come on, owing to problems in the mid-continent, in the West Coast, in the Gulf Coast, prolonged maintenances. So demand for crude really hasn't been as strong as it ought to be. And as a result, that's one of the main reasons we've seen a big build. We knew production was going to be high. We knew imports were going to be relatively low and exports relatively high. The big number where many of us got wrong has been on crude runs. Now, the good news about that is that over the next couple of weeks, crude runs are going to increase, and crude stocks are going to begin to draw finally at long last. But they've built way higher than what many of us had thought. Now, the good news about crude runs being not where they should be, gasoline stocks are in good shape. They're below the 4-year average, and distillate stocks are okay. They're a day below the 4-year average. So at least light products are in okay shape. In fact, gasoline's a little bit low going into the driving season. So, I think that's the good news. The bad news is that because crude, at least on the Gulf Coast, owing to the strength in Brent, some of the offshore crudes have gotten very strong, and PADD 3 refinery margins are not good. Asian refinery margins actually aren't that good either, and that's yet another bearish factor for the market. Is refinery margins globally are probably not as good as they should be, because the premiums on some of these crudes have gotten pretty high. Now, let's move away from the U.S. S&D and just take a broader view. We continue to think, looking at the supply-demand balances for the second and into the third quarter, particularly the third quarter, looks as though, owing to the loss of Iranian crude, the continuing loss of Venezuelan crude, and the Saudis not yet increasing production, although they said they would if needed. It does look like as we head into the third quarter and runs grow globally, we are going to draw stocks, and there looks like there's going to be a shortfall, which what was the bullish scenario. I think it still is the bullish scenario. So despite this, despite the sell-off here, we still like them. We still do like the market. We think the market will find some stability, and it has every chance in the world to turn up. And we do have the geopolitical problems also.
Andy, a quick question for our listeners who may not be familiar with it. With all of the uncertainties and the recent attacks in Saudi Arabia, how come there's not a lot of risk premium associated? The crude price drop, you explained some of the factors, but could some of the geopolitical factors really take over and we start to see more of a risk premium associated with the crude? So maybe talk to our listeners what that means.
And that is, of course, one of the amazing questions is and also was probably a bearish cue for the market with all the attacks in the Persian Gulf and the Saudi oil facilities in the past. The market would go crazy on that, and it wasn't really going up. Now we made a new interim high and then came off, but that too. Was probably a negative factor. And I think the reason the market hasn't gone crazy is that, one, there probably is signing right now a low probability that there's actually going to be a supply cutoff owing to hostilities. And two, the Saudis have said that they could make up some of the Iranian shortfall. We don't even know what the Iranian shortfall is, because some of the April and May barrels are now arriving. So we're getting it's difficult to assess where Iran is, where Iranian production is and Iranian export numbers are. But obviously the market took a look, took a broader look, and said, hey, we really don't think there's going to be a supply cutoff, owing to the straits being closed. But that doesn't mean there couldn't be. And obviously, with the U.S. buildup in the Persian Gulf, events can unfold in a different direction.
So it remains to be seen.
It definitely remains to be seen. Yeah, no doubt. Now we have an OPEC meeting coming up that may be postponed till July. They're talking about postponing it till July, again, to try to get more data out on where Iran is, whether China buys Iranian barrels, and the Saudis have to make their own decision on whether they're going to increase production. They're at 9.8. They say they're going to be at 9.8 million barrels a day production. They say they're going to be there for May and June. And, we'll see where they go in third quarter. I'm thinking they will end up increasing production by up to 500,000, which would still they'd still conform to the deal that they made with the Russians. But even with that increase, the market's still going to be short. So, it looks like a pretty interesting couple of months coming up.
Andy, question for you. Where do you see Iranian production finally coming out at? I don't think it'll go to zero. So
No.
Where do you see it?
Exports will not go to zero. I think right now they're at about 1.3 million barrels a day of exports. Maybe a little lower, maybe 1.2. That was the April number. May is going to be lower than that, possibly 800 a day. I think that it'll settle out at about 500,000 to 600,000 a day.
And who's going to be buying it? Who's going to be buying it? The Chinese?
Well, there's going to be leakage. Whether there's third party,
right,
to China or third party to India, there's definitely going to be leakage. They're sending barrels to Syria. So, there is going to be some Iranian on the market. Okay, well, that's all I have, really.
Good. Let's hear from Ed.
Okay, thanks very much, guys. Well, on my side, we've been looking at, of course, base metals, precious metals, and the month of May, true to form, sell in May and go away. Like Andy, I was, moderately bullish on the group going early into the month. I thought the base metals would kind of have one final rally once this trade agreement was sort of negotiated. And of course, President Trump threw a wrench in the works by just blindsiding everyone with his announcement that the deal was off. So we've been selling off since then, both in base metals and in some of the precious metals like platinum and palladium. Of course, since then we've had this thing has morphed from an economic deal to more of a political deal, which makes it all the more dangerous. Today, Secretary Pompeo said that China is a national security threat. So, once you start going into a political rabbit hole with the Chinese, things really become dicey, I think. And that's why, the markets are just selling off with a vengeance. And we're seeing a big sell-off in equity markets as we speak as well, with the Dow now down 400 points. This trade component is really infectious. It's not only between the US and China, it just spills, it has tentacles spreading everywhere. So one of the bigger casualties are the Europeans. German companies have about 5,300 operations in China. So when China slows down, it automatically impacts what's going on in Germany. And in fact, today we got the IFO business index out of Germany, the lowest reading since 2014. European Purchasing Managers Index came out as well at 51.6, barely growing, unchanged from last month. And then we have the European elections, parliamentary elections slated for tomorrow. all these establishment parties aren't expected to do well. So, you could see pressure on the euro. Sterling is already under pressure. It's hit a 2019 low, close to it. There's rumors that Prime Minister May be resigning as early as tomorrow. So all in all, it's kind of a very convoluted picture. What was holding base metals up for a long while was the fact that inventory levels were very low across most metals: copper, zinc, nickel, aluminum. Aluminum is starting to come down as well. So that kind of gave the market some support. However, we're starting to see stocks starting to creep up now, just as demand is also weakening. So that story of a tight market on the supply side, kind of like crude in a way, is starting to not hold up as much. And so this week we've really had a big sell-off in a lot of the metals, with key support levels being taken out, especially in copper, aluminum, and zinc. Now, gold has been stuck dead in the water for weeks now. You would have thought that with all this that's been going on, you would see some more interest in gold. We're finally starting to move today. We're up about $10 an ounce at $12.83. But if you look at the gold chart, it's still very much stuck in a range. But I think with all this uncertainty, it could probably have another test higher, certainly break above $1,300. That's what we're looking for, especially if U.S. stocks continue to head south. I think what's keeping gold restricted is the fact that the general dollar index is very strong. So we're seeing it right now at around 98. It's at a 1-month high. Very strong against all the major currencies except the yen. The yen is kind of moves up with the dollar, as does the Swiss franc. So all in all, where do we go from here? I think we're kind of in a no man's land in terms of trade talks. There's no talk scheduled right now. The Chinese said today that they're not going to be doing anything for the foreseeable future unless the U.S. corrects, its wrong actions, quote unquote. So we don't see any dialogue happening until possibly end of June, when President Xi and Trump meet, and maybe by then we could see the two leaders kind of call a truce and get the markets to stabilize a bit.
Okay. Ed, thank you very much. Ed, one question.
Yeah.
On copper, do you see significantly lower, or do you think we're close to a level of stability?
I think we could probably we're close. The low we've called for the year, just as a reference point, is 57.50. We predicted that back in November of last year when we did our annual outlook, and we're about 5% away from that number. So I think at around 5,700, this is the 3-month price basis the LME. A lot of these mining companies will really start to feel the pinch, and we could see investment deferrals, production cutbacks if we get down to those levels. So it's probably another 5% from here, and the bulk of the decline will probably be behind us. But, a lot depends as to what, if the world economy tips into recession or not, which at this point we just don't know.
Okay, so close, but we'll still to be seen. All right. Well, thanks very much, Ed, and thanks, Marty. Again, this is Andy Lebow from Commodity Research Group and Ed Meir from Commodity Research Group. You can see us on the web at the internet at commodityresearchgroup.com, and you can get a hold of me and also Ed the same way, Lebow at commodityresearchgroup.com. Marty?
Thanks again for the opportunity to participate. I always learn something especially on the metals side, which is a new field for us. And if folks are interested in continuing to learn more about our industry, the oil and gas side, to supplement the Talking podcast that we do to keep you current on industry events, we now have a weekly newsletter called Energized, which is a bit of a blog and links to important websites that will keep you current on what's happening in this important industry. It can be found at www.ektinteractive.com. I'd like to thank everyone for listening.